Hey everyone, and welcome. So you've started earning, you've got some money coming in, and now you're asking, what's next? Well, you're in exactly the right place. This is your straight up, no bluff guide to mutual funds. We're going to give you the confidence you need to start investing in your future. Okay, let's get into it. I want you to think about investing like a journey. You know, a road trip. Your money, that's the fuel. And your goals, maybe it's a down payment on a house, a trip around the world, or just not having to worry about money later in life, that's your destination. The whole key is just choosing the right vehicle to actually get you there. So, here's our map for this journey. We'll start with the roadmap itself, then get into choosing the right kind of fund. After that, we'll look at plans and payout options, how to read the key numbers, how to actually start your SIP, and finally, and this is super important, getting into the right mindset for the road ahead. Okay, so first things first, why are we even talking about mutual funds? Well, it's pretty simple. For most people who are just starting out, they're one of the best and easiest ways to get going. They basically take all the hard work of picking individual stocks off your plate and get you on your investment journey fast. And the idea behind them is actually really simple. You, me, and thousands of other people, we all put our money into one big pot. Then, a professional fund manager takes that big pot of money and invests it in dozens, sometimes even hundreds of different companies. Instantly, you get diversification. It's like owning a tiny little slice of a whole bunch of different businesses all at once. All right, so if a mutual fund is our vehicle, now we have to pick the right model, right? Are you looking for something stable and steady, like a family sedan? Or are you after a high-performance sports car? Your choice really just depends on how comfortable you are with risk and, how fast you're hoping to grow your money. This table breaks down the main options perfectly. Large cap funds, think of those as your reliable sedans. They invest in the biggest, most stable companies, giving you pretty steady conservative growth. Mid-cap funds are kind of like a sporty crossover. They go for companies that are on the rise, so you get a balance of higher growth potential with medium risk. And small caps, while those are the sports cars, they invest in small, high-potential companies. The growth could be huge, but so is the risk. So what if you want a bit of everything? That's where Flexi Cap and multi-cap funds come into play. A Flexi Cap fund is like handing the keys to a really skilled driver, the fund manager, who can move your money between large, mid, and small companies, however they think is best. A multi-cap fund, on the other hand, has to follow a strict rule. It has to keep a certain minimum amount invested in each category, so it's a bit more structured by design. Now, there's another special kind of vehicle called an ELSS fund. The big selling point here is that it's your tax-saving co-pilot. Any money you invest in these can actually be deducted from your taxable income. The catch? There's always a catch, right? Well, your money is locked in for at least 3 years. Okay, so we've picked our vehicle type. Now it's time to customize the features. And listen, this part is absolutely crucial because it directly affects how much your investment can grow and how you'll get your money back. This might be the single most important choice you make. A regular plan means you bought the fund through an advisor who gets a commission. A direct plan means you cut out that middleman and buy straight from the source. Now, here's why that matters so much. With no commission to pay, the direct plan has a lower annual fee. That tiny 1% difference might not sound like much, but over 20 or 30 years, it can mean your final investment is 20 to 30% bigger. That is a huge, huge difference. Going direct is one of the smartest things you can do. Next up, what do you want to happen with any profits the fund makes? With the growth option, all profits are automatically put right back into the fund to buy you more units. That's the magic of compounding, and it's perfect for long-term goals. The dividend option, which you might see called IDCW now, does the opposite. It pays out the profits directly to your bank account. That's more for people who might need a regular income from their investments. Now it's time to look at the dashboard. Before you put any money in, you've got to know how to read these key indicators. They're going to tell you everything about the fund's costs, its rules, and how it's done in the past. First on the dash is the expense ratio. This is the annual fee you pay for having a professional manage your money. It might look like a small number, maybe 1%, but trust me, over decades, that fee can eat up a massive chunk of your potential returns. So the rule here is super simple. The lower the expense ratio, the better, period. Next to that, you'll see the exit load. You can think of this as a penalty for leaving the party too early. Most funds will charge you a small fee, usually about 1%, if you cash out within the first year. It's really just there to encourage you to think long-term, so just be aware of that 1-year mark. And of course, you're going to want to check out a fund's track record. You'll see charts just like this one showing how it performed over the last 3, 5, and 10 years. It gives you a sense of its history. But, and this is a really big but, past performance is absolutely no guarantee of what will happen in the future. It's just one piece of the puzzle, not the whole picture. You know, a much smarter way to look at performance is by checking the rolling returns. Think about it like this. A normal return chart is like a single snapshot of a runner crossing the finish line. You don't know how they ran the race. Rolling returns are like having a video of the entire race. You see how they handled the uphill climbs and the easy parts, which gives you a much, much better idea of how consistent they really are. All right, enough theory. Let's get to the action. It's time to talk about the easiest, most disciplined way to start investing. It's called a systematic investment plan, or SIP. Seriously, starting a SIP is so easy. First, you do a one-time thing called KYC, which is just verifying your identity online. Then, you pick your fund. Remember, go for the direct plan and growth option for long-term goals. Decide how much you want to invest every month and pick a date. And finally, you just set up an automatic payment from your bank. That's it. It's true set it and forget it investing. So, you've started the engine, you're on the road. But getting to your destination isn't just about having a great car. It's about the driver. Honestly, the most important part of this whole thing is having the right mindset for the long trip ahead. And who better to learn from than Warren Buffett? The stock market is a device for transferring money from the impatient to the patient. It's so true. The market will have its ups and downs. There will be bumps. Impatient people panic and sell when things look bad, usually the worst possible time. Patient investors just stay the course, and in the long run, they're the ones who get rewarded. Look, investing in stocks and equity funds is a long-term game. You really need to plan on staying invested for at least 5 or 6 years, if not longer. That gives your money enough time to recover from any bumps in the market and really let that compounding magic work. And please make sure your monthly investment amount actually matches your goals. Figure out what you need and then work backwards to see how much you need to invest. And finally, let's be real, this is the no-bluff guide after all. Investing isn't risk-free. There's market risk, which means your returns are not guaranteed and you can lose money. There's concentration risk. If you put all your eggs in one basket, you're taking a big gamble. Liquidity risk means some smaller funds can be hard to sell quickly. And finally, you have no control over which specific stocks the manager buys. But understanding these risks doesn't mean you should be scared. It just means you're becoming a smarter investor. So, there you have it. We've looked at the map, we've picked out a vehicle, we've learned how to read the dashboard. Your financial journey has a destination, and a mutual fund SIP is a fantastic way to start driving towards it. The only real question left is, are you ready to get behind the wheel?